February 2026. COMEX registered silver inventory, 82 million ounces. March open interest, 425 million. The math doesn't work. Everyone knows it. But here's what they're missing. The reason the math doesn't work isn't because of what's coming. It's because of what already happened. January 30th, 2026. Silver hit $121, then $78. In one day, 35% gone. While you were watching the price, three things happened simultaneously. JP Morgan closed 3.17 million ounces of silver shorts at exactly $78.29, the exact bottom. The London Metal Exchange went dark, and the CME raised margins for the third time in 1 week. This wasn't a crash. This was an execution. The paper silver market just died. And when March delivery arrives, the world will realize it's gone. This is the silent ledger. And what I'm about to show you is not speculation. Every number, every date, every transaction, public record, verified. And it proves that January 30th wasn't volatility. It was the funeral of paper silver. Let me start with something that should be statistically impossible. 3 Six Sigma events in 1 week, silver, gold, Japanese 30-year bonds. A Six Sigma event means the probability is 0.0001, 97%, 1 in 500,000. 3 of them in 1 week. The probability is near zero, but it happened. January 28th through January 31st. And here's what nobody's asking. Why did all 3 happen at the exact same time? Let me start with something that should be statistically impossible. 3 Six Sigma events in 1 week, silver, gold, Japanese 30-year bonds. A Six Sigma event means the probability is 0.000197%, 1 in 500,000. 3 of them in 1 week. The probability is near zero. But it happened. January 28th through January 31st. And here's what nobody's asking. Why did all 3 happen at the exact same time? Why did silver crash at 35% in 1 day while JP Morgan closed shorts at the exact bottom? Why did exchanges go dark during the most violent move in 46 years? And why did the CME raise margins 3 times in 7 days leading up to the crash? Because they knew. They knew March was coming. 425 million ounces of open interest, 82 million ounces of registered inventory. They knew the paper market couldn't survive delivery. So they executed it before anyone could demand physical. Here's the timeline. And every single data point is public record. January 8th, 2026. CME raises silver margins. First hike, January 12th. CME raises margins again. Second hike in 4 days, January 13th. CME switches from dollar-based margins to percentage-based margins. This is critical. Percentage-based margins mean when price rises, margin requirements rise automatically. When silver hit $120, traders needed to post 15% of contract value. That's $90,000 per contract, up from $60,000 just 2 weeks earlier. Forced liquidation begins, January 28th. Silver hits $117, still rising. Open interest in March contract, 85,000 contracts. That's 425 million ounces. Against registered inventory of 82 million. The squeeze is building. January 29th, Thursday. Silver peaks at $121.64, all-time high. Then something happens. Reuters publishes a story claiming the U.S. is stepping back from plans to guarantee minimum prices for critical mineral projects. The story is false. The Department of Energy later calls it deliberately misleading. But by then, algo-driven selling has started. January 30th, Friday. This is the day. Silver opens high. Then at exactly 10 a.m. Eastern, the crash begins. $78.29 by noon. 35% down. Worst single day since March 1980. The Hunt brothers collapse. And while retail traders are getting liquidated, while margin calls are forcing selling, while the price is in free fall, JP Morgan does something extraordinary. They close 3.17 million ounces of silver shorts, 633 delivery contracts, all settled at $78.29. The exact bottom. Not $78, not $79, $78.29. The precise intraday low, and let me say that again. JP Morgan closed 3.17 million ounces of short positions at the exact moment silver hit its lowest point of the day. And then silver reversed. By the close, it recovered slightly, but the damage was done. Retail traders wiped out, leveraged funds liquidated, and JP Morgan sitting on massive profits. This is not speculation. This is CME delivery data. Public record, 633 contracts, all JP Morgan, all at $78.29. But wait, there's more. On the same day, the London Metal Exchange went dark, trading halted, systems offline. HSBC, one of the largest precious metals clearing banks, systems went offline. Same day. And the mainstream media blamed volatility. They blamed Kevin Warsh's nomination as Fed chair. They blamed risk-off sentiment. Nobody mentioned that JP Morgan just closed a $10 billion short position at the exact bottom of the worst silver crash in 46 years. Now let me show you why this matters for March. Because the crash didn't solve the delivery problem, it made it worse. Before January 30th, silver was trading at $120. Industrial buyers, hedge funds, arbitrage traders, they were all positioned to take delivery. They had the capital, they had the contracts, they were ready. Then the crash happened. Price dropped to 78, margin requirements spiked, forced liquidations everywhere. But here's the critical part. The people who got shaken out weren't the ones demanding delivery. They were speculators, leveraged traders, paper players, the industrial buyers, the ones who need physical metal, they're still there. They didn't get margin called because they're hedging real production or real consumption. They don't use leverage. So now you have a situation where March open interest is still around 85,000 contracts, 425 million ounces. But registered inventory has actually dropped since the crash, from 103 million ounces in early February to 82 million now. 21 million ounces drained in less than a month. The delivery squeeze didn't go away. It got tighter. And the crash just removed the speculators who might have rolled their contracts forward. What's left are the industrial players who actually want metal. Let me walk you through what a delivery looks like on COMEX. When you hold a futures contract and you stand for delivery, you issue a notice. The exchange matches you with a seller. The seller has 3 business days to deliver the metal from a COMEX-approved vault. You pay the contract price, you take ownership, the metal is yours. Now, in a normal market, most contracts don't go to delivery. Traders roll them forward or cash settle. But March 2026 is not a normal market. In January 2026, 49.4 million ounces were delivered. That's 7.27 times the January 2024 level. February hit 18.72 million ounces, 98% delivery rate. These are not normal numbers. If March sees even a 50% delivery rate, which is lower than February, that's 212 million ounces of demand. Against 82 million ounces of registered inventory, the gap is 130 million ounces. There is no vault on Earth that can close that gap in 3 business days. And here's where it gets existential. COMEX can raise margins. They already did, 3 times in 1 week. They can halt trading. They can force cash settlements. But they cannot create silver that doesn't exist. And for the first time in modern history, we're about to find out what happens when a major commodity exchange cannot fulfill delivery obligations. Now let me show you the historical parallel that everyone's missing. March 1980, Hunt Brothers silver squeeze. Silver hit $50, then crashed to $11 in 4 days. Why? The exchange changed the rules. They raised margins. They restricted new long positions. They forced liquidation. The Hunt brothers couldn't post the margin. They defaulted. The market collapsed. Sound familiar? January 2026. Silver hit $121. CME raised margins 3 times. Price crashed to 78 in 1 day. Forced liquidation. But here's the difference. In 1980, the Hunts were trying to corner the market. They were speculators. They failed. In 2026, it's not speculators driving delivery. It's industrial buyers who need the metal for batteries, solar panels, semiconductors. They can't be squeezed out because they're not using leverage. They're hedging real consumption. And here's the other difference. In 1980, there was no supply deficit. The crash released metal back into the market. In 2026, silver has been in a supply deficit for 5 consecutive years. Global demand exceeds mine supply every year since 2021. The deficit is covered by above-ground stocks, vaults, inventories. And those inventories just drained by 21 million ounces in 3 weeks. So when COMEX raised margins and crashed the price, they didn't solve the physical shortage. They just killed the paper speculators. And now the only buyers left are the ones who actually want delivery. Let me paint you 3 scenarios for what happens when March delivery starts. Scenario 1, the managed collapse. COMEX convinces enough contract holders to accept cash settlement. They offer premiums above spot. They threaten with forced liquidation. They source emergency metal from eligible inventory, from London, from wherever they can. They survive March, barely. Registered inventory drops to near 0. And every delivery month after March faces the same crisis with even less metal. Silver spikes to $150, $200 as the market realizes how close we came. Scenario 2, the partial default. COMEX delivers to some contract holders but forces cash settlement on others. Maybe they prioritize industrial buyers over hedge funds. Maybe they negotiate payment above spot to get people to walk away. The market fractures. Paper silver trades at COMEX price. Physical silver trades at massive premiums. Shanghai is already $30 above COMEX. That gap explodes to $50, $70, $100. The futures market loses credibility. Physical becomes the only real price. Scenario 3, the systemic break. Enough contract holders refuse cash settlement that COMEX cannot deliver. The exchange declares force majeure. All contracts settle in cash at a government-determined price. The paper silver market collapses. Physical silver disappears from public markets entirely. Industrial buyers panic. Tech companies that need silver for electronics, batteries, solar, they go directly to mines and lock up supply with multi-year prepayment deals. Samsung already did this. La Parilla mine in Mexico. 100% of output for 2 years. $7 million prepayment. If 10 more tech companies do the same, 50 million ounces per year disappear from exchanges permanently. And here's what makes scenario 3 more likely than anyone wants to admit. The paper to physical ratio. Right now, March open interest represents 425 million ounces. Registered inventory, 82 million. That's a 5-to-1 ratio. But that assumes all 82 million is actually available. It's not. A significant portion of registered silver is already encumbered. It's held on behalf of clients who have first rights. It's tied up in derivative positions. It's pledged as collateral. The pool of truly deliverable, unencumbered silver is much smaller than 82 million. Nobody knows the exact number, but it's less, possibly a lot less. So the real paper-to-physical ratio might be 8-to-1, 10-to-1, 15-to-1. And when delivery notices start hitting in late February, COMEX will find out exactly how much metal they actually have. And if the answer is not enough, the entire fractional reserve commodity futures system collapses. Because if COMEX can't deliver silver, what does that say about copper? Gold? Oil? Every commodity traded on leverage. Every futures contract backed by a promise instead of physical metal. The trust evaporates. And trust is the only thing holding the system together. Now let me show you why JP Morgan's move on January 30th proves they know this is coming. JP Morgan was fined $920 million in 2020 by the Department of Justice for manipulating gold and silver prices between 2008 and 2016. Spoofing, fake orders, price manipulation, convicted, settled, public record. And on January 30th, 2026, they closed 3.17 million ounces of silver shorts at the exact bottom of the biggest crash in 46 years. That's not luck. That's not market timing. That's insider knowledge. They knew the margin hikes were coming. They knew when. They knew the algo selling would cascade. They knew the bottom would be 78.29. And they positioned accordingly. While retail traders got wiped out, JP Morgan made billions. And here's the part that should terrify you. If they knew enough to close at the bottom, they know what's coming in March. And their move tells you everything. They went from short silver to long physical, from betting against the rally to taking delivery of actual metal. That's not a trade. That's a strategic repositioning ahead of a market structure failure. Let me give you the data that confirms this is accelerating. In January 2026 alone, over 33 million ounces were withdrawn from COMEX vaults, 26% of registered inventory. In 1 month, the withdrawal rate is 785,000 ounces per day. If that continues through February 27th, which is first notice day for March delivery, registered inventory will be around 65 million ounces, maybe less, against 425 million ounces of open interest. The math goes from impossible to catastrophic. And here's what's happening that most people are missing. While COMEX registered inventory is draining, physical premiums are exploding. Shanghai silver is trading $20 to $30 above COMEX. Dubai? Same thing. Japan was seeing 80% premiums in late December. 80%. Physical buyers are paying $130, while COMEX quotes 78. That's not a functioning market. That's a market where paper and physical have completely divorced. And when that divorce becomes obvious to everyone, the paper price collapses to zero, because nobody trusts a contract they can't enforce. Now let me connect this to the broader macro picture, because the silver story is not isolated. It's part of a systemic unraveling. On December 26, 2025, the New York Federal Reserve delivered $17 billion in emergency cash to an unnamed bank. Emergency repo. Nobody knows which bank. Nobody knows why. But it happened on the same day CME started raising silver margins. Same week, China announced export controls locking 60 to 70% of global refined silver inside Chinese borders. Same week, silver started going parabolic toward $120. These events are connected. The financial system is under stress. Banks need liquidity. Central banks are intervening. Commodity exchanges are raising margins to prevent clearing failures. And physical commodities, the real assets that actually exist, are separating from paper contracts. This is the beginning of a monetary system breakdown. And silver is the canary. Here's what happens next. First notice day for March delivery is February 27th. That's 18 days from now. On that day, anyone holding a March contract can demand delivery. COMEX has 3 business days to produce the metal. If they can't, they default. And default means one of two things: Force majeure, all contracts settle cash. Or emergency intervention, government steps in, exchanges close, contracts frozen. Either way, the paper silver market ends. And here's what you need to understand. This is not about fear. This is not about panic. This is about recognizing that the system changed on January 30th. JP Morgan at the bottom. Exchanges going dark. Margin hikes during the crash. Six Sigma impossibility. These are not coincidences. These are the fingerprints of a controlled demolition. They executed the paper market before it could collapse on its own. And March delivery is when we find out if they succeeded. 3 Six Sigma events in 1 week. Silver down 35% in 1 day. JP Morgan closing shorts at the exact bottom. COMEX inventory draining 785,000 ounces per day. March open interest 425 million ounces against 82 million registered. Physical premiums at $30 in Shanghai. Industrial buyers locking mine output before it's even produced. And 18 days until first notice day. This is not a silver trade. This is a system failure. The paper market died on January 30th. It just hasn't been officially declared yet. And when March delivery starts, when the notice is hit, when COMEX has to produce metal they don't have, the world will realize that paper silver was always just a promise. And promises don't conduct electricity. They don't make batteries. They don't power the grid. Only physical silver does that. February 27th, first notice day. 425 million ounces will demand delivery. 82 million ounces might be available. And the gap will prove that the paper market is gone. This is the silent ledger. The execution happened on January 30th. March is when the world finds out. Now you know what's coming.